Welcome to vTalkInsight Allocator's Lens Daily for January 23, 2026. Cross-asset markets are trying to balance surprisingly strong U.S. growth, a powerful artificial intelligence investment cycle, and simmering bond market fragilities. Risk appetite is rebuilding after this week's wobble. But under the surface, we see heavy rotation across equities, fresh questions about the diversification role of sovereign bonds, and a steady drift toward real assets as long-term hedges. Let's begin with equities, where the growth and AI narratives are still in the driver's seat. In equities, the dominant story is that the macro engine is still running hot while inflation is quietly easing, a combination that continues to underpin the bull market even as volatility pops up. Weekly jobless claims are holding near 200,000. Personal consumption has been running in the mid-single digits year-on-year, and third-quarter U.S. growth was revised up to 4.4%. Looking ahead, U.S. growth forecasts around the high twos for 2026 and expectations for productivity gains in the 4 to 6% range point to an economy that can still deliver robust revenue growth. That macro strength is flowing into earnings, with commentary pointing to low double-digit profit growth potential and examples like GE Aerospace, where orders, revenue, and operating profit all posted double-digit increases. Price action reflects that backdrop. After a sharp 2% equity pullback earlier in the week and a brief spike in volatility, major U.S. indices have bounced, daily gains have moved back into positive territory, and the volatility index has slipped into the mid-teens. We are still in a bull market regime, but one where multiple 5 to 10% drawdowns are seen as likely on the way to any higher year-end levels, which keeps the focus on liquidity and staying power rather than short-term timing. Under the surface, the rally is broadening materially. Small caps and transports are leading year-to-date, with benchmarks like the S&P 600 and the Russell 2000 up high single to double digits, and small caps outperforming large caps for 14 straight sessions. Flows are rotating away from last year's mega-cap leaders into under-owned cyclical sectors such as energy, industrials, and materials, as well as into smaller and mid-cap technology names. The AI investment wave is central to this rotation. Major technology platforms are projected to invest more than $1 trillion in AI infrastructure over the next 3 years, with some estimates suggesting global data center spending could roughly triple to around $1.4 trillion over 5 years. AI-related equity indices have just logged some of their strongest two-day gains in months, and chipmakers are rallying on guidance that building out AI infrastructure will require trillions of dollars in cumulative capital. At the same time, the underlying supply chain is tight. Memory and advanced nodes are in shortage. The NAND memory market is expected to stay undersupplied for several years, and that is already showing up as pressure on PC and smartphone volumes. This mix of surging demand and constrained supply explains why semiconductor funds are trading at all-time highs and well above long-term trend lines. For allocators, the tension is that AI is clearly a multi-year growth engine, but parts of the theme already look stretched. Some prominent semiconductor names have seen their valuation multiples expand to levels not fully backed by changes in earnings expectations, and one large chip producer has rallied more than 40% this year and over 80% last year, while consensus profit forecasts have barely moved. Individual stories are mixed as well. One major CPU maker issued guidance with flat earnings and ongoing supply challenges, triggering an after-hours share decline despite the broader AI enthusiasm, while a key competitor is gaining market share and is better positioned to benefit from those shortages. In private markets, aggressive fundraising efforts at very high valuations for leading AI firms and heavy venture capital flows into early-stage names suggest a risk that expectations run ahead of delivery and lead to future write-downs. Putting it together, the equity picture is one of strong macro and earnings support, broadening leadership, and powerful AI and defense spending tailwinds, offset by valuation froth in select technology pockets and the likelihood of episodic corrections. From here, many investors are watching the upcoming personal consumption expenditures inflation report, the next Federal Reserve meeting, and the next leg of earnings season in semiconductors, defense, and cyclicals as key catalysts for the equity narrative. Turning to rates, markets are treating the current backdrop as a steady state. The Federal Reserve is widely expected to stay on hold for now, with little conviction around near-term rate cuts. Recent upside surprises in growth have pushed expectations for policy easing further out, yet the inflation data have been moving the other way. 3-month annualized consumer price inflation is running near the mid-ones, and several observers see scope for inflation to surprise on the downside through 2026 as shelter and food components cool. Against that mix, the 10-year Treasury yield has settled in the low 4s, with many seeing a trading range between roughly 3.75 and 4.25%, while the long bond has retreated well below the highs it briefly touched during the autumn sell-off. Beneath that apparent calm, however, there are significant fault lines. Recent turmoil in Japanese government bonds, where a relatively small amount of trading erased tens of billions of dollars in value and pushed yields to record highs, has underscored how thin liquidity can be at the long end of sovereign curves. That episode fed directly into swings in U.S. Treasuries and highlighted how interconnected global bond markets have become. At the same time, structural deficits, quantitative tightening, and concerns about the long-term value of money are feeding worries that term premia will need to stay higher, and that oversupply of government debt could at some point crowd out other spending or weigh on risk assets. For now, measures of bond market volatility remain low by historical standards, which makes this underlying fragility easy to underestimate. Investor behavior reflects this mix of income opportunity and structural concern. Flows into short-dated Treasury products remain strong, emphasizing safety and liquidity, but there are early signs of gradual reallocation toward the intermediate part of the curve, which many see as a sweet spot between yield and duration risk. Global fixed income diversification is also regaining importance. Institutional investors are adding exposure to fiscally conservative issuers such as Germany, Canada, Australia, Norway, and Singapore, and improving public finances in places like the United Kingdom are helping ease upward pressure on local yields. In the near term, the personal consumption expenditures print and next week's Fed communication are key signposts for whether this benign range trading regime can hold or whether another bout of long-end volatility, perhaps again triggered offshore, reopens the debate about how bonds fit alongside equities as portfolio hedges. In credit, the tone remains broadly constructive. Strong economic data and resilient earnings are supporting demand for U.S. corporate bonds, even as primary issuance stays heavy. Spreads on high-quality issuers are tight, and while some well-known technology credits trade wider than the strongest megacaps, yields in the mid-single digits signal that markets see business as challenged in places but far from distressed. Flows into large investment-grade and high-yield exchange-traded funds have been mixed, yet much of that appears driven by their use as liquidity and hedging tools rather than wholesale to risk or re-risk trades. Looking ahead, the AI and data center build-out is expected to drive a wave of new corporate borrowing, which could put some upward pressure on spreads as supply ramps, even if demand remains solid as long as earnings hold up. Consumer and financial credit show a more complex picture. A proposed cap on credit card interest rates in the low double digits, while seen as unlikely to pass in its current form, would, if implemented, remove well over $100 billion of annual revenue from the industry and could sharply restrict credit availability for the most vulnerable borrowers. That in turn could hit consumption and raise questions about financial stability if banks were no longer able to price risk effectively. For now, political momentum has slowed, bringing some relief to the banking sector, and several large lenders are experimenting with new card products that feature voluntary interest caps to address public pressure. At the same time, deregulation is encouraging more merger and acquisition activity, and institutions that were previously constrained by regulatory limits, such as certain large U.S. banks, are now growing balance sheets again. Beyond these sector-specific stories, there's a broader concern that markets may be underpricing risks tied to overall debt dynamics. High debt service costs and the prospect of continued heavy bond issuance could at some stage constrain public sector support for growth or reduce demand for other assets. Legal and reputational shocks, such as high-profile lawsuits against major banks, add another layer of idiosyncratic risk that feeds into the case for issuer-level differentiation. In this environment, credit still offers income and selective spread opportunities, but the balance of risk and reward is becoming more dependent on sector, capital structure, and sensitivity to policy or refinancing shocks, especially as the rate and AI investment cycles evolve. Foreign exchange markets are grappling with two opposing forces on the U.S. dollar. On one side, the combination of strong U.S. growth, resilient corporate earnings, and the country's leadership in AI adoption continues to attract capital, with foreign investors directing trillions of dollars into U.S. equities over the past year. With the Federal Reserve in a holding pattern and not rushing toward aggressive rate cuts, several observers expect the dollar to remain stable or only slightly weaker this year, even though many trading desks still talk about a softer dollar as the consensus view. On the other side, recent price action has seen periods of persistent dollar softness, which has benefited U.S. multinationals and investors holding unhedged foreign exposures, but raised questions for those focused on currency stability. Overlaying the cyclical picture is a slower-moving structural trend toward de-dollarization. Central banks have been increasing their purchases of gold and diversifying reserves away from the dollar and the euro, and some large European pension funds have reduced their U.S. Treasury holdings. Commentary highlights a gradual erosion of confidence in dollar-based assets that does not always show up in day-to-day foreign exchange moves, but could matter a great deal over a multi-year horizon. In practice, this means the dollar may oscillate in a broad range in the near term, supported by U.S. growth and asset performance, even as the longer-term architecture of reserves and invoicing slowly shifts, with gold playing a larger parallel role. Commodities sit at the intersection of growth, inflation, and geopolitics, and they're becoming increasingly central to cross-asset allocation. In precious metals, sustained central bank buying has helped drive gold prices sharply higher, with major investment banks lifting their year-end targets and framing gold as a strategic hedge against geopolitical risk and declining faith in fiat currencies. Gold has remained firm even on days when equities rally on better trade headlines, suggesting that investors still see meaningful policy and geopolitical tail risk. Silver has also attracted strong demand, with prices nearly doubling from earlier highs, supported by substitution from gold in key markets and robust inflows into exchange-traded products. Together, gold and silver are functioning both as hedges against macro shocks and as expressions of the slow move away from exclusive reliance on the dollar in the global system. In energy, there's a clear distinction between short-term, weather-driven volatility and longer-term structural stories. Natural gas prices have spiked by around 60 to 70% in a matter of days, driven by an Arctic blast, record short covering, surging heating demand, and concerns about production freeze-offs in key shale regions. That move has obvious near-term implications for inflation prints and household budgets. Yet U.S. oil and gas production overall remains at record highs thanks to a decade of innovation that has lowered break-even costs, and lower average global energy prices are still expected to support both U.S. and global growth over time. Crucially, natural gas infrastructure is increasingly seen as a bridge asset for the energy transition and as a way to power the electricity-hungry data centers that underpin AI, which has helped make energy the top-performing sector in broad U.S. equity indices so far this year. Industrial metals round out the commodity picture. The AI data center build-out is creating new sources of demand for materials like aluminum, where each gigawatt of capacity requires significant tonnage, and the global market is already in a mild deficit, particularly in North America. More broadly, a decade of underinvestment in metals such as platinum, copper, and uranium has left supply tight and made these markets highly sensitive to fresh capital inflows or policy-driven demand, including from the energy transition and rising defense budgets. Major oil companies are exploring expansion opportunities in regions like Venezuela, but large-scale projects are likely to wait on clearer political and legal frameworks. For allocators, this leaves commodities positioned both as a cyclical play on growth and weather, and as a structural hedge against de-dollarization, geopolitical risk, and the physical demands of AI and defense spending. Stepping back across assets, the current configuration is one of resilient growth and disinflation supporting equities, a powerful AI and defense Capex cycle reshaping sector leadership, and bond markets that offer income but show clear signs of structural fragility. Credit conditions remain benign overall, yet policy debates around consumer lending and the prospect of heavier AI-related issuance are creating pockets of asymmetric risk. The dollar looks range-bound for now, held up by strong U.S. assets even as reserve managers quietly diversify toward gold and other stores of value, while commodities sit at the nexus of safety hedging and long-term demand from AI, energy transition, and defense. From an allocator's perspective, the key watch points in the coming days are the personal consumption expenditures inflation release, next week's Federal Reserve signals, any renewed stress in global sovereign bond markets, and how AI-related earnings and spending guidance evolve across technology, infrastructure, and industrial names. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.